Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Before investing your money in a business, it is important to understand exactly what you are investing in and whether the opportunity is worth the risk. A promising business can look attractive from the outside, but smart investors know that appearances are not enough. Before putting your money into any company, you need to evaluate its financial health, business model, management team, market position, growth potential, and risks. Learning how to evaluate a business before investing can help you make more informed decisions and avoid costly mistakes. The first thing to understand is the business model. Ask yourself a simple question: how does this business actually make money? A company may have impressive sales, a popular product, or a large customer base, but if its business model is difficult to sustain, the investment may not be attractive. Look at what the company sells, who its customers are, how much it charges, and how much it costs to deliver its products or services. You want to see a business model that is understandable, practical, and capable of generating sustainable profits. Next, examine the company's revenue. Revenue represents the money a business generates from selling its products or services. However, high revenue does not automatically mean a business is financially healthy. A company could generate millions in sales while still losing money because its expenses are too high. That is why investors should look beyond revenue and examine profitability. Pay attention to gross profit, operating profit, and net profit. Understanding these numbers can give you a clearer picture of whether the company is actually making money. Cash flow is another critical area to evaluate. A business can report profits on paper but still experience serious cash problems. Cash flow shows how money moves into and out of the business. Strong and consistent cash flow can indicate that the company has enough money to pay employees, suppliers, loans, and other expenses. When evaluating an investment opportunity, ask whether the business regularly generates cash from its normal operations. A company that constantly needs outside funding just to survive may carry significantly higher risk. You should also examine the company's expenses. Look at where the business spends its money and whether those expenses are necessary and manageable. Some expenses may increase as the company grows, while others may remain relatively stable. Investors should understand whether the business has healthy margins and whether it can maintain profitability if costs increase. Rising rent, labor costs, raw material prices, advertising expenses, or technology costs can significantly affect profits. A strong business should have a reasonable strategy for managing these pressures. Another important factor is debt. Debt is not always bad. Many successful businesses use loans to expand operations, purchase equipment, hire employees, or invest in new opportunities. The problem occurs when debt becomes difficult to manage. Examine how much the business owes, what interest rates it pays, and whether its cash flow is sufficient to cover its debt obligations. A highly profitable company with manageable debt may be in a stronger position than a rapidly growing company carrying excessive financial obligations. The market itself also deserves careful attention. Even a well-managed business can struggle if the market is shrinking or becoming extremely competitive. Research the industry and determine whether demand for the company's products or services is growing, stable, or declining. Consider economic trends, customer behavior, technology, regulations, and other factors that could affect future demand. You want to understand not only where the business is today, but where its industry may be several years from now. Competition is another major consideration. Find out who the company's competitors are and what makes this business different. Does it have better pricing, stronger customer service, a recognizable brand, unique technology, better distribution, or another advantage? A business without a clear competitive advantage may find it difficult to maintain customers and profits when competitors enter the market. Customer concentration is also worth investigating. If a large percentage of the company's revenue comes from only one or two customers, that can create significant risk. Losing one major customer could dramatically reduce revenue. A healthier business may have a diversified customer base that reduces its dependence on any single client. Investors should also look at customer retention. If customers repeatedly return and continue buying, that can be a positive sign that the business provides real value. The management team is one of the most important factors in any investment decision. A strong business can fail because of poor leadership, while a struggling business can sometimes improve under experienced management. Research the backgrounds, experience, reputation, and track records of the people running the company. Consider whether they understand the industry, make responsible decisions, communicate clearly, and have a realistic plan for growth. You are not only investing in a business, in many cases, you are investing in the people responsible for making that business successful. Transparency should also matter to investors. Be cautious when business owners refuse to provide important financial information, avoid difficult questions, exaggerate future profits, or pressure you to invest immediately. A legitimate investment opportunity should allow you enough time to review the information and make a decision. If someone tells you that you must invest today because the opportunity will disappear tomorrow, consider that a warning sign. You should also evaluate the company's growth potential. Growth can come from acquiring more customers, increasing prices, entering new markets, launching new products, improving operations, or using technology more effectively. But growth should be realistic. Extremely optimistic projections are not the same as evidence. Look at historical performance and determine whether the company's future expectations are supported by actual market conditions and business capabilities. Valuation is another critical part of the evaluation process. Even an excellent business can be a poor investment if you pay too much for it. Imagine finding a company with strong profits, loyal customers, and excellent growth potential. If the investment price is far higher than what the business is reasonably worth, your potential return may still be limited. Investors should compare the asking price with revenue, profits, assets, cash flow, growth expectations, and comparable businesses when possible. Risk assessment should happen before you invest, not after something goes wrong. Think about what could cause the business to fail or lose value. Could new competitors enter the market? Could regulations change? Could customers stop buying the product? Could the company lose a key employee? Could supply costs rise? Could technology make the product outdated? Writing down the major risks can help you determine whether the potential reward is worth accepting those risks. It is also important to verify the information you receive. Do not rely entirely on presentations, sales pitches, or verbal promises. Request financial statements, contracts, business registrations, tax records where appropriate, debt information, ownership documents, and other relevant records. If the investment is significant, consider working with qualified financial, legal, and accounting professionals who can independently review the opportunity. Finally, think about your own financial situation. A great business does not automatically mean it is the right investment for you. Consider how much money you can afford to invest, how long you can leave the money invested, how much risk you can tolerate, and what would happen if you lost some or all of your investment. Never invest money that you cannot afford to lose simply because someone promises high returns. Evaluating a business before investing is ultimately about replacing excitement with evidence. Look at the business model, revenue, profits, cash flow, expenses, debt, market, competition, customers, management, growth opportunities, valuation, and risks. Ask difficult questions, verify the answers, and take your time before making a commitment. The goal is not to find a business with zero risk because no such investment exists. The goal is to understand the risks clearly and determine whether the potential return justifies them. Smart investing is not about guessing which business will become successful. It is about gathering information, analyzing the facts, understanding what you are buying, and making a decision based on evidence rather than emotion. When you learn how to evaluate a business before investing, you give yourself a much stronger foundation for making financial decisions. Whether you are considering a small local company, an online business, a startup, or an established company, the same principle applies. Do your research, understand the numbers, investigate the people behind the business, and never rush into an investment you do not fully understand. The more carefully you evaluate an opportunity before investing, the better prepared you will be to protect your capital and pursue long-term financial growth. Please like, share and subscribe for more exclusive content.